Cody out of the shot. Hey, welcome to Happy Hour, everybody. This is Rebecca Gomez. Oh, he's back, and Cody Willard as well.
And this is Happy Hour, where Jim DePore is not the only one who hunts like a shark. More on that in a minute.
Sharks are rare. Tigers, too. He could be a tiger, but it's sharks.
The reason I say that, by the way, one of my idols, mentors, and good friends, I finally got to meet him just yesterday in real life, Jim RevShark DePore.
My good friend Russell's here, too. But first, we want to touch on a Fox Business alert. After 4 down days, the markets rallied back, gaining some of the ground lost since last week. The Dow gaining 319 points, up almost 2.5%. The S&P rose nearly 42 points, gaining 3%. Positive news out of Walmart, helping to move stocks into positive territory, and we'll get into all of that in a moment. But also, the tech-heavy NASDAQ soaring nearly 90 points, up a solid 3% for the day. Does that mean tech is back? Well, Apple, Google, Research in Motion, and VMware among the stocks that drove the NASDAQ higher today. So, are we back in the tech rally?
You know, we talked about yesterday that these stocks would finally bounce when everyone decides that they were no longer safe and all the momentum guys had bailed out of it. You got the relief bounce today, and what a relief bounce it was. 10 to 15% moves in some of those stocks that were down 10 to 15%. The fact of the matter is, when they've been crushed like they've been, as badly as they've been in the last 10 days, I think you got to let them settle in a little bit. As a trader, I wouldn't exactly be rushing in and saying tech is back into the year end.
However, though, I mean, I would think that if you were wanting to get into Yahoo, Google, VMware, I mean, now you can snap them up at bargain prices. You know, what are you going to wait until they're back and, you know, the momentum is truly there and these stocks are back at numbers that we saw before they dissipated last week? And you never know which way it's going to move. So maybe, you know, you say, well, wait, should I wait tomorrow? But they may be up another 3% tomorrow, and you lose gaining them at a bargain today.
That being said, I mean, they're already up 10 to 15% where you could have bought them yesterday, so they're not nearly the bargain they were yesterday.
We talked about it yesterday, too. I said yesterday for people to start snapping them up because I thought that, yeah, indeed, they're bargains, and these companies aren't going anywhere, and there wasn't really substantial news that these companies were justifying them losing so much, other than that maybe they were at high levels already.
Right, and they had run so far. And yeah, you know, I do think that technology is the place to be if you're going to be in the market. So certainly, if you don't have enough exposure to technology, you want to buy the stocks when you can and not when you have to. Is another one of my mentors.
Good point. E-Trade, we saw some recovery with E-Trade today too. But again, we don't want to say that it's completely recovered from you know, when it dropped 58%.
Yeah, yesterday down 60%, up 40% today, which net you don't do the math. 60 minus 40, still down 35% in the last 2 days. If it had been down 20% yesterday and another 15% today, we wouldn't be talking about how E-Trade got a bounce. We'd be talking about how it's still getting crushed.
However, again, you look at it from the perspective, you know, because it bounced back because E-Trade came out and said, look, you know, we're reinsuring investors, that we are federally insured. You know, your money's, if we go bankrupt, which was the speculation, your account, you will be reimbursed on your accounts, not for stock losses or, you know, investments that they made. And also there's speculation that E-Trade may be bought up by maybe a Charles Schwab, TD Ameritrade, and then if that's the case, if you buy the stock now, you're definitely going to get a bargain, but that's if it is bought by somebody else.
If you truly believe that E-Trade is a target and about to be taken over, absolutely, it's a great trade. Right. I don't believe that, and I don't think you want to. There's another lesson that I've been taught from over the years from a mentor, that you don't just buy a stock off of expectation that maybe it gets taken out. You want to make sure the fundamentals are good, and E-Trade does not have good fundamentals right now.
Right, although that's the part of the risk you take as an investor. If you do purchase, being that risky, taking that risk, and it does pan out to be true, that you make some good money.
And certainly, as badly as that stock's been crushed, it is certainly priced in some of that potential downside.
Let's cover briefly Walmart, earnings up 8%, better than expected. And we watch Walmart a lot because it's the biggest retailer in the world, and this is definitely a bellwether. It's become like a bellwether economic company that we can gauge how well the consumer is doing or not. But also, Walmart, you have to keep in mind that they've really changed their business strategy. First, they were thinking about going after higher end, like Target customers, and then they said, nah, that doesn't work. And then they really started slashing prices, and now that didn't work. So now they're really trying to find the right mix, and which seems to be working.
Right. Well, and I wouldn't actually say it seems to be working. They had just taken expectations so low across the street that they had something that wasn't horrible, and you get a relief rally again. Everyone's like, oh, Walmart's saying things are okay. No, they're not saying things are okay. They're just saying things are not dire.
Right, right.
And
And compared to last Christmas season, where they didn't do well at all, they're changing their strategy.
The last few quarters, Walmart's had a lot of problems.
I do want to mention the parent company of TJ Maxx and Marshalls, also their earnings up 13%. And again, it just gives us some gauge of how well we will be doing this holiday season, because a retailer, remember, consumer spending 2/3 of what drives our economy.
Can I go ahead? And I'm very excited to have RevShark join us today. Jim, I'm so thrilled to have you.
Hi, Jim. Nice to meet you.
Nice to meet you. Thank you.
RevShark and I have been writing together. Actually, you gave me one of my first breaks. You asked me to substitute in your diary once on realmoney.com a few years ago, and I just took that and ran as best I could with it.
Well,
you did an excellent job.
And
here you are.
Since you know Jim so well, I have to ask, where does the whole RevShark nickname come from? What is that all about?
The RevShark itself. Why do you call yourself RevShark, Jim?
Well, RevShark comes from saving souls from buy and hold, and that's where it originated. That back in the early days of the internet, when the Motley Fool was the primary place for many investors, I sort of rebelled against their buy and hold philosophy, and it was always been my thesis that active investing is much safer and more conservative than buy and hold investing.
You know, you've teased me, not teased actually, you said several times, Cody, you ran a risky kind of hedge fund, and I've pushed back on you, and that's partly where I get that idea that trading per se doesn't translate to risk necessarily. Jim has always argued that buy and hold is not the right way for an individual investor to invest.
Right. Well, buy and hold is basically hoping that the stock that you bought is going to work out over the course of many years. If it doesn't, you have opportunity costs. You've got things working in reverse for you over the course of a year. Compounding is great if it works positively, but compounding is horrible if it works negatively.
And to clarify, I mean that more with mutual funds and people who have their 401ks. With stock investing, I just tell people that you've got to keep on these stocks. You can't just because one day we say, hey, this is a great buy, because we may not necessarily tell you when to sell it. We're not telling you day of, but you have to really follow specifically if you're going to stock invest. You have to do your homework, and this is something that maybe a lot of people don't have the time, because it's very time consuming if you're really going to do it right.
Right, and you do say that, and that's such a great point. You do need to focus on them.
Well, it's only in the stock market where being passive is seen as being seen as being a better approach. I mean, in any other activity, if you're active, if you react and move and do things, you're better off.
So, Jim, let's talk about the markets today. You see, the NASDAQ bounced 3%. Are you bullish on the technology here? Are you worried you got to have a little more consolidation? What are you looking at here?
I think that we are going to have a rally into the end of the year.
In technology, per se?
In technology, particularly. And I also think that this might be the time, finally, for some of the small caps to finally show some life.
The small caps have been crushed this year.
They've been doing very poorly this year, but now we're heading into the seasonally good time for the small caps, and there's so many that are bargains now that have done nothing because all the money's been piling into a handful of big caps for so long.
Throw a few names out for us in the small cap world. What are you looking at right now? You got 2 or 3 stock names?
There's a few, there's a lot of little ones that I look for. What I look for is something with a growth rate about twice its PE.
PE cost you $2 in this jar. Tell everybody what you mean by growth rate twice its PE.
Well, I want to see stocks that are growing at a rate faster than their valuation, basically. So like one, for example, that I was looking at today that I own already, it's called Blue Phoenix, that does migration of computer systems from the old COBOL and all that to the more current stuff. It's an Israeli company, and it's supposed to grow its earnings about twice what its current, I shouldn't use that word, PE. But that's one example of one that I've been looking at. But there's a lot of those out there right now because they have not done much this year.
Well, and so when you're watching the news today and you see, when you see the volatility, what I call the dislocations from yesterday we get crushed, today we come right back, does that make you more bullish? How does that actually factor into your trading outlook?
Well, one of the interesting things about the market this year is we've had a whole inclination of V-shaped moves.
Oh, I guess we're having microphone problems, Jim. Sorry.
Got it. But I think we heard most everything you said, by the way.
We have had a series of V-shaped recoveries this year. Every time we break down, we come straight back up. Now, the technical analysis handbook says that's
not supposed to happen.
That's not supposed to happen. We're supposed to go down, back up, up, and up like that. We're supposed to be choppier. But that has not occurred this year, and it's left a lot of people very frustrated because they've never had the opportunity to get in unless they buy at the first dip on a day like today. Now, a day like today really gets a lot of people nervous because we've had these recoveries straight back up. So they say, do I buy now or do I wait for another pullback?
You got an answer for us? You're saying buy now.
I think that you got to inch in a little bit right now, keep some powder dry, and
Awesome. Jim, we're going to bring you back at the bottom of the hour and talk much more about shark investing.
Very good. Thank you.
More of your controversial. Sit down for just 1 second. We'll wrap it up.
Well, you already teased him. We'll be right back.
Guys, we'll be right back. We got the shark on the screen for you, too.
Oh,
Bell bottom.